What if I told you the US is drowning in over $36 trillion, 0 cents of debt, and no one knows how to stop it? While politicians argue and Wall Street profits, the average American is paying the price through rising inflation, soaring interest rates, and shrinking opportunities. This isn't just an economic story, it's a national emergency with global consequences. In this video, we uncover how America got here, who's benefiting, and what collapse could look like if nothing changes. Can the US be saved? Or is the fall already in motion? Watch before it's too late. The United States has officially crossed a jaw-dropping $36 trillion, 0 cents in national debt, a number so massive it's hard to even comprehend. But how did the richest country on earth end up here? It didn't happen overnight. Decades of aggressive government spending, costly wars, tax cuts, and financial bailouts have gradually inflated the debt. Starting in the early 2000s, wars in Iraq and Afghanistan added trillions. Then came the 2008 financial crisis, prompting massive stimulus spending to save Wall Street and the banking system. Fast forward to 2020, the COVID-19 pandemic hit. The government injected over $5 trillion, 0 cents, into the economy through stimulus checks, business bailouts, and unemployment benefits. Though necessary, it came at a massive long-term cost. Compounding the problem is that the US government continues to spend more than it earns. Interest payments on the existing debt alone now exceed hundreds of billions per year, a figure that rivals the entire defense budget. Meanwhile, political gridlock in Washington means real solutions are rare. Each new administration adds to the problem rather than solving it, kicking the can further down the road. The result? A ticking time bomb. The $36 trillion, 0 cents figure isn't just symbolic. It represents a looming crisis with global implications. In the next section, we'll dive into how this debt affects the average American. From rising inflated $36 trillion, 0 cents debt, it isn't just a number on a government spreadsheet. It's already impacting your daily life. For the average American, this crisis translates into higher costs, shrinking opportunities, and growing uncertainty. Let's start with inflation. As the government prints more money to service its debt, the value of the dollar declines. This makes everything more expensive, from groceries to gas to rent. And while wages may rise slightly, they often lag far behind soaring prices, reducing your real purchasing power. Interest rates are also on the rise. To attract buyers for US Treasury bonds, the government must offer higher returns. That means banks and lenders raise their own rates, making it more expensive to buy a home, finance a car, or pay off credit cards. Then there's job security. When interest rates rise and consumer spending falls, businesses tighten their belts. Layoffs, hiring freezes, and reduced hours often follow. Entire industries feel the pressure, especially small businesses already struggling to survive post-pandemic. And don't forget Social Security and Medicare. With debt climbing, these safety nets are under immense strain. Future retirees may face reduced benefits or delayed eligibility. Simply put, the debt crisis isn't a future problem. It's already reshaping your financial reality. Coming up next, what's driving the debt higher and who's benefiting from it? Let's expose the forces profiting from America's decline. To job uncertainty and interest rate hikes. The US national debt has become a runaway train, but who's at the controls? And more importantly, who's getting rich while the country drowns in red ink? Start with Congress. Both political parties have contributed to the debt crisis through massive spending bills, often filled with pork barrel projects, defense contracts, and corporate tax breaks. Politicians talk about fiscal responsibility, but when it comes to votes and campaign donors, spending wins elections. Then, there's the Federal Reserve, which has kept interest rates low for years and engaged in massive money printing through quantitative easing. While this helped stimulate the economy short-term, it also devalued the dollar and fueled asset bubbles. Wall Street is another big winner. Every time the government borrows more, banks and investment firms profit by trading bonds, managing debt, and investing in inflation-proof assets. For them, the crisis is a cash cow. Meanwhile, defense contractors benefit from ballooning military budgets. Tech giants and pharmaceutical companies rake in subsidies and government contracts. Even foreign nations like China, a major holder of US debt, benefit from a dollar-dependent system that keeps American consumers spending. At the core, the system is built to reward debt-fueled growth, not long-term sustainability, and those in power are too deeply invested to stop it. But where does this all lead? Next, we'll explore the global implications, how America's debt threatens economies far beyond its borders. America's debt crisis doesn't stop at its borders. When the world's largest economy sinks deeper into financial turmoil, every country feels the ripple effects, and some are already scrambling to protect themselves. The US dollar is the global reserve currency, used in international trade, oil deals, and foreign reserves. But with $36 trillion, 0 cents, in debt and rising inflation, many nations are starting to lose confidence in the dollar's long-term stability. As a result, countries like China, Russia, and even some in the Middle East are reducing dollar holdings and turning to alternatives, including gold, digital currencies, or regional trade pacts. International markets also watch U.S. debt levels closely. A spike in treasury yields, driven by debt fears, can cause panic sell-offs in stock markets worldwide. Emerging economies are especially vulnerable. As the U.S. raises interest rates to manage inflation, global investors pull money out of developing nations, triggering currency crashes and debt crises abroad. America's allies are uneasy too. With rising interest payments, Washington may cut back on foreign aid, military spending, and international commitments. This leaves power vacuums that other nations, particularly China, are eager to fill. Meanwhile, global institutions like the IMF and World Bank warn that a U.S. debt collapse could trigger a worldwide recession or financial shock worse than 2008. The U.S. isn't just risking its own future, it's putting the global system on edge. Can the United States, the most powerful economy in the world, actually collapse under its own debt? As terrifying as it sounds, many experts say it's not just possible, it's already in motion, unless drastic changes are made. First, let's be clear, defaulting on the debt would be catastrophic. It would destroy global trust in U.S. bonds, cause the dollar to crash, and instantly trigger a global financial meltdown. Investors, both foreign and domestic, would dump U.S. assets. Banks could freeze credit. Panic would ripple across stock markets. But even without a full-blown default, a slow collapse is already underway. As the government borrows more just to pay interest, the debt grows exponentially, known as the doom loop. Eventually, the U.S. could be forced to slash essential programs, raise taxes sharply, or inflate its way out, all of which hurt everyday people. Social Security, Medicare, infrastructure, even military funding could be gutted. Inflation could spin out of control, destroying savings. The U.S. might lose its AAA credit rating permanently, raising borrowing costs even higher. Some economists warn of a Japan-style stagnation, while others see a more violent crash, a Great Depression too. Either way, the path is unsustainable. So what's the solution? Is there a way out? In our final section, we'll explore potential paths to recovery and whether America still has time to turn this around. External. What happens if the debt spiral continues? Is collapse really possible?